An IRS audit. That's a topic that can make just about anyone a little nervous. But what if I told you that you could seriously lower your chances of ever getting that dreaded letter in the mail? In this explainer, we're going to uncover the key triggers the IRS is looking for, and more importantly, how you can stay off their radar. Just imagine getting this in the mail. Ugh, these are the words nobody wants to read. This is the official start of an IRS audit, and it can kick off a process that's long, stressful, and, let's be honest, potentially very expensive. So why all the fear? Well, it's pretty simple. Audits take up your time, they cause a ton of stress, and they can end with you owing more in taxes plus interest and penalties. It's a major headache you definitely want to avoid if you can. So that really is the big question, isn't it? Is this just a game of chance? The good news is no. The answer is you absolutely can reduce your risk. Now, there are no guarantees, of course, but knowing what the IRS looks for, well, that's your best defense. So let's break down their playbook. Okay, first up, who's actually on the radar? I mean, while technically any return can be selected for a closer look, the odds are definitely not the same for everyone. Certain factors can dramatically increase your chances of getting that notice. The main thing to understand here is that complexity invites scrutiny. Think about it. The tax returns for business owners, people who are self-employed, and the wealthy, they're just way more complex. And that means there are more opportunities for errors or discrepancies, which naturally draws more attention from the IRS. And this chart illustrates the point perfectly. Just look at this data from 2022. If you were a taxpayer earning between, say, $50,000 and $500,000, you had a pretty low audit rate. But jump all the way up to those with incomes over $5 million, and you can see the rate is by far the highest. More money, more complexity, more audits. It's that simple. So what exactly are these red flags? Well, here's the great part. They're not a big secret, which means you can actively work to avoid them. We're about to walk through the 5 biggest audit triggers that both the IRS computers and their agents are trained to spot. All right, trigger number 1. This is a big one. This is a huge one: mismatched or missing income. See, the IRS has this powerful, automated system that matches the income you report against the forms they get from banks, your clients, and your brokerage. Any kind of discrepancy with those 1099 forms, from investments, dividends, or that side hustle, is an instant red flag. The solution here is really just simple diligence. You have to account for every single 1099 form, because you can be sure they are. For income from a business or a rental property, your own records are your proof. And be extra careful with something called a 1099 composite from your broker. It bundles a bunch of reports into one document, which makes it really easy to overlook something. Next up, let's talk about trigger number 2. What's really interesting here is that it all comes down to consistency. A big unexplained jump or even a drop in your reported income from one year to the next is a major red flag. To the IRS, it might look like you forgot to report some income this year, or maybe even in a previous one. This is a really common flag for business owners and freelancers whose income can vary a lot. The key is to get ahead of the story. If you know there's a perfectly good reason for that big change, tell the IRS yourself. Most tax software actually lets you add supplemental notes. For instance, if your business income dropped because you lost a huge client, explaining that right on your return can often prevent an audit from ever starting. Trigger number 3 is all about business losses. The IRS gets it. They know that new businesses often lose money in the first few years. That's totally normal. But when a business reports losses for many years in a row, the IRS starts to ask a critical question. Is this a real, legitimate business? Or is it a hobby that's just being used for tax write-offs? Your defense here is all about documentation. I'm talking about keeping bulletproof records of every dollar that comes in and every dollar that goes out for at least 7 years. You need to be able to prove that you're running a legitimate business with a real intent to make a profit, not just funding a personal passion project. And now for trigger number 4, an area that really trips up a lot of people. This one is huge because it's all about deductions. Now, let me be clear. You should claim every single deduction you are entitled to, but you need to know that some get a second look more often than others. The big ones to watch are really large charitable donations compared to your income, rental property losses, and, of course, the home office deduction. Once again, your defense is documentation. For big charitable gifts, know the limits, which are based on your adjusted gross income, or AGI. For rental losses, the rules can be very strict and complex. And this is crucial. The home office deduction is now almost exclusively for self-employed folks, not for employees who just happen to work from home. That's a super common mistake. And our fifth and final trigger, well, this one involves a very specific high-stakes tax return. This one applies to estate tax returns, which, by the way, are already audited at a very high rate. And the biggest reason? The IRS suspects that the assets in the estate, things like art, real estate, or private business, have been valued too low just to reduce the tax bill. And trust me, the IRS has its own team of very savvy valuation experts. So the best strategy here is to build a defensible position from the very beginning. For any asset that doesn't have a clear market price, like a piece of art or a family business, go out and get 2 or 3 independent appraisals from qualified professionals. Using an average of these expert opinions creates a much stronger, much more credible valuation if the IRS ever comes knocking. Now, if you do get that letter, it's really important to know that not all audits are created equal. The word audit might make you think of agents raiding your home, but that is very, very rarely the case. This table breaks it down nicely. The most common type, by a long shot, is a correspondence audit. It's handled entirely by mail, usually for simple things like a missing form. A step up from that is an office audit, which means you have to go visit an IRS office. And the one everyone fears, the field audit, is the most comprehensive. It happens at your home or business, but it's also the rarest. So, after all of this, what's the most important thing to remember? Well, it really all boils down to taking ownership. I want you to remember this. Even if you hire a tax professional to prepare your return, you are the one signing it. The ultimate responsibility for its accuracy falls right on your shoulders and yours alone. Never, ever sign a return that you haven't reviewed and understood yourself. So let's just boil it all down to your 4-point defense plan. Number 1, report every single dollar of income. 2, keep organized, meticulous records for everything. 3, get multiple appraisals for those hard-to-value assets. And 4, always, always review your return before you sign it. No exceptions. I'll leave you with this final thought. At the end of the day, an audit is just the IRS asking you to prove the numbers you put on your return. If you've been diligent, your records will do all the talking for you. So the real question isn't just about avoiding an audit. It's this. If you were asked tomorrow, are your records ready to tell your financial story accurately and completely?